So on July 26th, the first installment of our series, we discussed the idea of Social Security and estate planning. And we learned in Social Security that by 2035, 21% of our benefits will be reduced. So we need to start planning around that event that's coming in 2035. We also learned in estate planning that it's never too early to have a will and know exactly what we own and where we want it to go upon our death. Last Sunday, August 2nd, we discussed debt consolidation. And in debt consolidation, the presenter, Dr. Simon, says better to consider debt settlement than consolidating everything in one lump sum. Today, we'll be discussing budgeting and investing. Budgeting will be presented to us by Dr. Simon, and after that, investments will be presented by Jonathan Archie. Dr. Simon is an assistant professor in business, in the School of Business, Technology, and Advanced Manufacturing at Goodwin University. Prior to joining Goodwin College in 2016, he served as a management consultant and tax advisor to small businesses and provided training to several nonprofit boards in New York City. Professor Simon has 25 years experience in management and administration in several disciplines from airlines, insurance, financial services, telecommunications. Professor Simon holds a PhD in business administration, a master's in education, and a bachelor's in management. Professor Simon?
Yeah. Good afternoon once again, my brothers and sisters. It's a pleasure to be part of this community again, this environment where we can continue to look at a lot of topics in personal finance. And with me today, who's going to be taking the second half of the presentation will be Jonathan Archie. And Jonathan is going to be dealing with all the issues surrounding investments. So what I did last week and what I'm going to do today, you're all going to point to him as the expert in investments. So I just want you to know that you may want to channel a lot of the investment questions to him since he's here today. So if the organizer can give me the opportunity to share my screen, I'll go ahead and share it. Yes, so today we are talking about budgeting. And budgeting is a very popular topic. If you live in the United States long enough, you know, come at the end of the year, even the government will be talking about budgeting. Organizations to which we belong to talk about budgeting. It seems as though we can do nothing without a proper budget in place. And so today I want to discuss budgeting more from a personal perspective, because some of us may hold senior positions in major organizations and corporations, and we have to deal with budgets every day. We have to deal with variance analysis. We have to deal with all these things. But when it comes to our personal life, we take a more laid-back approach and we assume that things will fall into place. And things sometimes do fall into place. Sometimes it doesn't. And so today I just want to discuss the whole topic about budgeting. And there are some facts about budgeting that I want to share with you. And it says that basically 56% of all US, are you guys seeing the screen clearly?
Yes.
56% of all US adults do not have a budget. They do not work with a budget. And that's a phenomenally high number. Um, on the other hand, there's another 40% who have a budget and keep track of basically their expenditures, like food and entertainment and all the other monthly expendables that they have to deal with. Another 20% of our US adults do not have a good idea of how much they spend. And so the statistics are alarming. It doesn't shock you when you come to the last bullet point that says 50% of all marriages in the United States end up in the divorce code because of poor money management. So it seems as though a ticket to the divorce code is pretty much a function of you not managing your personal finance. And so these are some of the statistics out there, and we want to zero in on how best we can do things to not be a part of this statistic, but to reflect the good side of what budgeting really should be all about. What is budgeting? The textbooks talk about budgeting from so many perspectives. If you ask politicians what a budget is, they tell you one thing. You ask a homeowner what a budget is, you ask a CEO what a budget is, they will tell you all kinds of things. But I like what John Maxwell said. He said, a budget is telling your money, where to go instead of wondering where it went. And I use the word, and I like the use of the word your money. Earlier this week, I had the privilege of being in the presence of a mom and her son who's about to go to work. And she was there trying to tell him how he should spend the money when he gets it. And his answer to her was pretty straightforward. He said, Mommy, are you going to tell me how to spend my money? 1 year ago, I had a similar experience with my own son, who said when I was trying to tell him what to do with a little bit of money that he's earning during the summer, he said, are you going to tell me how to spend my money? So there is a common consensus that generally speaking, people don't like you to tell them how to spend their money. They pretty much want to do what they want to do with their money, which is fine. At the end of the day, it is your money. But in the midst of all of that, the good counsel is you want to have a budget in place to tell you where your money should go. At least have a plan in place so that at least when you receive your income, your salary, your wages, you have some kind of concrete plan of where you want this money to go. Unless you want to end up like some people who at the end of the year, they said, did I work for all this money? I know people when they receive their W-2s, they're like, did I earn all this money during the year? Oh, yes, you did. Where did it go? No one knows. So budgeting is critical in helping you to understand where you want that money to go. So sometimes I try to figure out what budgeting is like, and I think most of you will know what Waze is. To me, budgeting is pretty much like Waze. If you want to go to Brooklyn today and you decide to use the Waze, you will tell the Waze where you want to go. You don't expect the Waze to figure out that you want to go downtown Brooklyn, New York, or you want to go downtown Boston. The Waze is not going to do that. You have to give the Waze a lot of information, and then the Waze is going to guide you safely there. And so budgeting to a large extent is pretty much like using Waze to get to a destination. Additionally, a budget is pretty much an estimate. There is no budget that is foolproof, that is 100% accurate, even with the best artificial intelligence we have in place, plus human intelligence. A budget remains an estimate because there are several things that we have no control over. Like, you know what? All of us, I've had great plans this year, go to Guyana, whatever it is. You know what? COVID changed all of that. And so all the plans I made financially to travel is gone because, you know what? There are always factors in the environment that will alter whatever we have on pen, whatever we have put on paper via pen. And so always remember that a budget is an estimate. And it's also good to remember from like an organization level. You may be in a nonprofit organization. People need to understand that the budget is an estimate. Budget is never accurate. There are always going to be things that are going to come in by the wayside, things you never planned for, things you overlook. So a budget remains an estimate and will always be seen as an estimate. So these two pieces of graphics, they depict what I call, so I'm trying to move away now from much more corporate into more the family, individuals and household, because I want to keep the discussion along there. So there are two routes you can take within the household. One, you can have an individual budget. If you're a single person, you may want to do a budget as an individual. People think that you should only do budgets when you have a family, when there's a lot of people around and you got to think of, no, even as an individual, a good habit is to plan your budget out. So individuals need to budget as well as families need to budget. And I specifically put up this image here to show like a husband and wife, and there are two kids down there because later on, I'm going to come back to this very graphic and make a statement. But families need to budget. And when I say families, it's not a case of husband, because the common thing today is that both of us are working, we're doing great jobs, we have the children. Like there's a common understanding that, you know what, my money is my money, your money is your money. But you know what, George, you're responsible for paying the water bill, the light bill, the gas bill. I'm going to pay the mortgage. You take care of all these other things. And that's pretty much how most households operate. But his money is his money, and her money is her money. I think in the very first presentation, Mr. McCray made reference to what you call financial infidelity. And a lot of couples practice this. They are not faithful to each other when it comes to their income. There's always something someone is hiding, what is going on beyond the background. And that affects your ability to budget, because probably all income is not accounted for, which I will deal with later down, and all expenses are not incurred for. Like I always remember once, I went to, I always go through counseling, and so the counselor was asking me, did you tell your wife that you normally send money for your mom like every month? I said, yes, she knows about that. He said, because some people do it and they don't talk about it. A wife might be sending money for her parents in Trinidad and she doesn't want her husband to know about it. So that in itself is financial infidelity. And that impacts the whole idea of having a budget, because there are hidden agendas within the budgetary plan of the home. In other words, what I'm advocating is that when there is a family budget, you know what, there should be trust and there should be integrity in the process, so that people are not hiding things from each other, that everything is laid on the table, and so that you can make and do the best budget possible. Another point I want to raise, and I'm going to get through quickly because I'm eager to have Brother Archie out here to talk about investments, because ultimately all that we're doing here is pointing to investments. So when it comes to budgeting, there are pretty much two views about budgets. There is a liberal view and there is a conservative view. And I'm not here talking about Democrats and Republicans. I'm talking about behavior of human beings. Some of us are quite liberal when it comes to budgeting and spending. Others are more fiscally conservative. So some people are fiscally liberal while others are fiscally conservative. Nothing is wrong with your orientation. The large issue is that you have to learn to be liberal within some constraint, within some parameter. And if you're conservative, you have to understand that you can't be overly conservative, because then you will not get things done. And I always remember, I can share this example. I always remember there was a specific organization that was struggling to increase investments. But these are like people who I think were pretty smart people, Until one day, I asked the pastor, said, do you realize that there are maybe other constraints here? There may be persons on the organization that have different views when it comes to spending. I said, have you ever thought about it? Some people are not very liberal. They might say, hold on to the money of the organization. Other people might say, why not spend it? You know, people have different views, and they take those views from their personal settings into a more corporate setting. And so it's important to understand why there is liberalism and why there is conservatism. Because you find that one of the three outcomes of budgeting is a budget deficit. And a deficit is where your expenditure exceeds your revenue. So where does the rest of the money come from? The rest of the money comes from overspending. And overspending because you have created a debt somewhere along the line. You probably can't afford to buy this thing because you run out of money. So you whip the credit card out and complete. So you're overspending, you're spending beyond your means. This is outside of your bracket. And so you find that people who are quite liberal tend to be mostly within the domain of overspending. Their expenses always seem to outweigh the revenues. They're always talking about being in debt and having credit card debt because that's a liberal view of spending. It results in a budget deficit. Then there is a budget surplus. That's the second outcome. And you find that persons who are more inclined and who are more conservative tend to save more and make more investments. The income, right, is always, that should be less than, sorry, I have it wrong there. But the income should always be less than their expenses. Income should always be less than expenses. That's when you have a surplus. You're bringing in $1,000, but you're spending $900. So you're saving money that you can invest in something. And the third option is where income is equal to expenses. At the end of the day, you're not creating any debt, but you're not also saving. This is safe. But with this behavior, which is more like a centrist view, you really can do any kind of investment because you're not saving any kind of money. So it's good that you're not owing anybody money, you're not generating debt, but then your ability to create wealth and to invest is limited because you are living, quote unquote, paycheck to paycheck. And this is a paycheck to paycheck scenario. The larger problem with budgeting has to do with cash flow. Cash flow is everything. And how we manage our cash flow will determine whether we are able to save or whether we'll be overspending most of the time. And so there are several things that people need to look at when it comes to cash flow. You want to know how frequently cash is flowing in. So for example, if your cash is coming in weekly, you have to budget around a weekly cash flow. If your cash is coming in every 2 weeks, every other week, you have to budget around that scenario so that you can be, in other words, I always say plan as you earn. I use the acronym PAYE, plan as you earn. You're earning monthly. You want to deal with your budgeting issues more on a monthly basis because your monies are coming in monthly. So cash flow is everything. At the end of the day, if no cash is coming in, then you can't really spend. So as the cash comes in, you determine how you want to spend and you make that plan and have it in place. At the end of the day, this is what you want to determine. You want to know, and so I'm back to cash flow. You want to know what is coming in, what is going out. You need to know that at all times. What are my inflows? What are my outflows? But in the process of inflows and outflows, you must also manage your assets and your liabilities. Because one outflow might be your mortgage payment. That's a liability. That's not an expense. You might be putting money into the bank as a saving. That's an asset. That's a liquid asset. So when you're managing your inflows and outflows, you're also advised to look at it from an asset and liability perspective, because last week I think I made note of it when I said some people are treating expendables, some people are treating expendables like if they are not, like if they are liabilities, and vice versa. For example, a mortgage is a liability, it's not an expendable. Your car note is not an expendable, it's a liability. You're paying your student loan, those are not expenses, those are liabilities. So when you're looking at your, oh, that's why I like to look at it more from an inflow, outflow perspective. Because you say income and expenses, you think everything is an expense. No, some of those outflows are expenses. The other set are liabilities. There are repercussions to not, you decide that you don't want to pay your mortgage, there are repercussions for it. You decide that you don't want to pay your car note, there are going to be repercussions. But let's put it this way. Let's assume that you decide, you know what, I'm going to cut my food bill by 20%. There are no repercussions to that. If you don't do it, there's not going to be any repercussions, someone come knocking at your door, because that's an expense that you decide you want to cut. You know what? You might say, I'm tired of cable. I'm going to just get internet and I'm going to stream into my home. That's an expense. You deal with it. Nobody has to tell you anything. So it's important that when you're looking at your inflows and your outflows, you determine what are really expendables and what are really liabilities, because there are repercussions if you decide you're not going to pay your mortgage. And I want to make some recommendations when it comes to budget. I want to keep it overly simple so that we can have a discussion on it. For those who belong to a church community, who are Christians, we are always advised to pay the tithe first. So in our budgets as Christians, that should be out of it. That 1/10 goes there right away. You always pay your tithe first. The tithe is not something you deal with long after the fact. If anything is left over, as Christians, we are admonished by the word of God to do this. So if people are here who are not Christians, don't take it hard, but pretty much as Christian, this is one of the beliefs that emanates from the Bible and the word of God. After that, I always advocate that you pay yourself. And some people say, how are you going to do that? Whenever you get your paycheck, the first thing you must do after paying your tithe is paying yourself. It doesn't have to be anything significant. I know a dude who puts aside $50 every paycheck. That's not significant, but he's saving. Every paycheck puts aside $50. In other words, he's paying himself for the hard work he's doing, but that's all he can pay himself for. Like if you have a business, you want to take care of all your expenses before you pay yourself. You know what? When you get your salary, pay yourself. That money you put aside as savings. The third point I want to leave with you today, third recommendation, is that you review your budget every time you get paid or an income. Remember, budget is activity-based. If there is no activity, there is no expenditure. So budgets are activity-based. So a lot of people were home for COVID-19 and they were working from home. Yeah, there were other expenses that go along with that, but you know what? What about a guy or a woman who traveled 80 miles a day to go to work, and they were paying gas and wear and tear on their vehicle for those months? You know what? They weren't using their vehicle so often. They weren't active. So always remember that a budget is activity-based. And when you sit to do your budget, always remember that you identify the activity, then you put a figure to it. Identify. If you plan to go to Jamaica on vacation next July, you plan to take your family, you got a budget for it. That's an activity. Put a figure to it. Don't wait until April month and say, you know what, the tickets to Jamaica is this, whatever it is. You know what? Because there's a common mistake a lot of people make. You ask them, they want to go to vacation in Trinidad. Oh, that's $425. What they're talking about is the cost of the ticket. How do you get to the airport in both countries, here and in Trinidad, to and from the airport? Where would you stop when you go down there? A hotel? Family members? How do you eat? Yes, you're going to take down the newest threads that you have, the best looking clothes. So how much would you buy in clothes? And then you have to take gifts to people. So the trip to Trinidad is not $425. It is much more than that, because there are activities associated with you traveling to Trinidad. And so you have to make sure that when you're budgeting, you look, if you don't remember anything else from today's discussion, remember that budget is activity based. The more sedentary you are in your life, the less you're likely to spend. The more busy you are, the more you're going to spend. So that's something that people may not be paying attention to. But because the other sites you can get around this, you can be someone at home and you can be racking up spending money every day buying from Amazon. So there's a flip side to it also. But generally speaking, budgets are activity based. The fourth point, include all money you receive, income and all the things you spend money on, expenses. Make sure, that's what I was saying from a family perspective, you want to capture every single item as best as possible. All the income, all the expenses. There should be no hidden expenses there. And you should not be making money by the side and your spouse doesn't know about it, because it impacts the overall purpose of why you are budgeting. Right? The other point I want to talk about is teach your kids about money at any age. We should not be afraid to talk. And that's why if you go back to that image, I showed you a husband, a wife, and 2 kids. And I specifically chose that because I want you to get the idea that, you know what? It's not too young to teach kids what budgeting is all about, and they should be an integral part of it. I'll tell you why. They might be making a lot of noise out there. I want a PS4, or the PS5 is coming out in another month. That's money that you have to spend. But they also have to understand where your money is coming from, what are the things you're doing, and how they can get it. What parents do, they go rack up a credit card bill to give the child a PS4 or the Xbox, or to give them a sneaker. They have to be part of the budgeting process so that they understand, you know what? This is all the money we have remaining. And part of this is savings. And you know what? This is entertainment. This is what we do. If you have to get a sneaker, we got to talk about that 6 months down the line or 3 months down the line. You have to let your children be an integral part of your budgeting. Most people keep them out of it. And I think that's a mistake we make. Let them be part. Let them understand what is taking place. Let them know what is taking place. There might be privacy issues, but you also need to let the children know what you are doing financially. Because you know what? Sometimes we disappoint them. They wake up to the fact that they will be that the house is foreclosed on and they got to move. You never told them that all along the way. They're not learning that a day before, or you're going to be evicted tomorrow. They know tonight. Why? Because you are not keeping them in the loop, the money loop. And you find the families that keep their children in the loop with money are much better able to manage expenses surrounding their children. And the last point I want to make before I hand over back to the organizer is that if you're married, ensure that one person's income can comfortably take care of the household. And let me tell you why. This might sound far-fetched, but it should be a goal of every married couple. Have you ever considered that your daily life is a function of both incomes? Should anything go wrong with one of the 2 persons, the responsibility goes on one person. What if my income can't cover the mortgage and can't cover the basic expenses? Then we have a problem. So I always advise couples that one of the goals you should set is to make sure that you guys are both earning at a level that should anything go wrong, one person's income can take care of the household and its expenses. Far-fetched, but it should be a goal of every couple. Thank you very much. And I want to acknowledge my good friend and colleague who A lot of the points I made today pretty much are points that she shared with me and we discussed over a number of years, Ms. Dixon. Thank you very much.
Thank you, Professor Simon, about the interesting ideas of budgeting. Learning to have kids actively involved. So next time parents, your child wants new Jordan shoes, you can say, hey, let's sit down and work the numbers. Can we afford it? And if not, say, you need to get a job. Just playing. But next, we have our presenter, Jonathan Archie, and he will be discussing investments. Jonathan D. Archie is an accomplished financial professional and the founder of Wise with Wealth, one of the largest financial literacy programs for churches across the country. Furthermore, he currently runs an insurance agency with over 15 agents across 6 states in the United States. With over 5 years experience in the industry, starting to invest in the markets since he was 18, Jonathan knows the ins and outs of Wall Street, and close to over 10,000 financial people. 10,000 people financially educated. Jonathan desires to empower and transform lives. His mission is to inspire people to lead the life that God has assigned and called them to be. He's eager to share his skills and knowledge on how to successfully build and maintain wealth. Our presenter now is Jonathan Archie.
Can you hear me?
Yes.
All right. Thank you so much, Ray, for that introduction there. And I also want to thank every single individual that made it possible for you to invest these few moments of your day on Sunday, where you can be outside enjoying the sunlight, to be able to speak, to hear as I speak on how to invest. And so what we are going to simply go through today, as the title is learning about investing. So if you don't have your paper and pen, get that together right now, because this is information that is worth, I believe, millions if you apply it. All right, so let me just change the screen. Am I a host? Okay.
Yes, you are.
All right, 1 second. All right, here we go. So before we even begin, I just wanted to start off in a quick prayer that God can definitely use me. So dear Heavenly Father, I want to thank you so much for just giving us the ability to spend this time together. I'm asking that you will give me insight on what to say to your people, and that it will not be my words, but your words alone. I pray in Jesus' precious name, amen. And so what we are going to go through today, as the title is learning how to invest. And we're going to teach you why stock investing is so important. He mentioned to you that I started trading at the age of 18. I wish I did it a lot earlier, but I would not be able to create a stock brokerage account until I was at the age of 18, unless I had my parents to be a custodian over me. However, they didn't have any clue of what investing was, except for their retirement accounts. Although it's one of the fastest ways that the individuals that you see today that are able to build their wealth, one of the secrets that they only teach in their families, right? You don't really learn in school how to invest in stocks. You don't learn about it in college. It's only something that you glance on TV. Every time you turn on the news, they say the Dow Jones has now gone up 500 points, and you hear the S&P 500, and everyone will simply just glance it on the screen for a few seconds, and most people are oblivious to understand what is happening. All they know about is a 401k or an IRA, but that is simply one of the things that I believe is so important for our people to know. We have to make sure that we are educated on all the financial concepts that are out here, because there is going to be a point that you will have to experience a terminated income, and all you will be able to survive upon is what you saved up. Unfortunately, because bank returns are very low, it's not possible to invest by putting your money in a savings account. The return is less than 1%. And so if you have a fixated mind to just putting your money there, I cannot help you. But if you have an open mindset to learning the real way to invest, get ready for it. Now, one thing I love to do is connect it to the Bible. And so what it simply says in Matthew 25, verse 16 to 21, if anyone heard of that in the Bible, there was a gentleman that was a master, and he came to provide a certain amount of talents to three types of people. And it says in verse 16, then he had received the 5 talents went and traded with the same and made them other 5 talents. And likewise, he that had received 2, he also gained other 2. But he that received 1 went and digged in the earth and hid his Lord's money. After a long time, the Lord of those servants cometh and reckoneth with them. And so he that had received 5 talents came and brought other 5 talents, saying, Lord, thou deliverest me unto me 5 talents. Behold, I have gained beside them 5 talents more. His Lord said unto them, well done, thou good and faithful servant. Thou hast been faithful over few things. I will make thee ruler over many things. Enter thou into the joy of thy Lord. And we saw what happened to the individual that had the 2 talents. He was able to double that as well. And the Lord said to him as well, well done, thou good and faithful servant. But the person that had the 1 talent, that hid it in the ground, that did nothing with the value of denarii that he received, which was the original exchange of funds that they used, because it didn't double, the Lord said to him, you're wicked, right? How could you lazy person, how could you not do something with the talent that I gave you? And what I want you all to realize is that if you can look at what happened to just the first person that had 5 talents, he was able to get around a 100% return on his investment. So he was able to double his investment. And so every single one of you have the ability to double every single asset that you have, to be able to hopefully do good things with it, such as giving to the poor and providing for other people. But most times what individuals usually do is they squander the dollars that they have, and they usually don't really have any other value to bring to the table. And so what Dr. mentioned before is the importance of having a budget. If you want to start investing, the preliminaries, first off, you must make sure that you have a budget that you're maintaining at least once a month minimum. Because if you start investing and you don't know where your dollars are going, you're not going to understand the value of investing and putting your money to delay the gratification instead of immediate gratification. And so it's so crucial. Once you have that budget in place, now after that, you will make sure that you are consistent in investing, not into companies, not into your retirement account. You invest into the treasures of heaven. Every time that you give tithe and offering, or you give to somebody that doesn't have the funds, God is taking note and recording every single thing that you are doing, because now you're in a position where you don't really have so much desire to hold all the money to yourself. When you invest, you let go of the money from your hands to let it work on its own. And that's the same thing when you give. The more you give is the more you shall receive. So if you are not inclined to give, just even to church, if you don't attend church, it's fine. If you're not giving outside of that, then I don't believe it's great to start investing yet, because investing, you have to be comfortable with not being in control of the money for a certain period of time. But if you need the money immediately, it doesn't make sense to invest. And the same thing with your giving and contribution. It's so important to make that your priority, because God will literally multiply and bless and bring showers of blessings, as he says in Malachi, to the assets that you're saving up. So one of the common things that people always say to me, hey, is it wise to invest as a Christian? I don't think that Christians should be investing. Well, let me tell you something. Investing, there's so many ways that you can invest, and there's legal ways to invest, and illegal ways to invest. And there's also legal ways and places where you can put your money to get a huge return in a short period of time without doing any labor or work. Now, I'm not telling you that you can become immediately rich quick by investing, unless you want to invest in the lottery, which there is no intrinsic value investing in the lottery. And that is what I call something that Christians should not even embark into. But investing, what all of you need to understand, when you invest in a company or in a stock, all you're doing is just purchasing value of a particular company for the product or service that they are selling, expecting for them to do better in the future. That's all you're doing. And so in the terms of the financial industry, we call it trading, right? And if you look at the trading sense, if you're just, let's say you're going to a store and you're selling goods back and forth, which a lot of individuals did in the biblical times as merchants, it was the action of buying and selling goods and services. So all those individuals, the individuals that had all the cattle and all the tents, and just like Paul, all they were doing, they were trading back there and then. All they were trading was just actual goods and services. So when you stock trade, when you trade in stocks now and invest, all you're doing is trading, buying and selling the shares of the particular company. And the share is just a piece of the equity of the value of the company. And once you have at least one share, which is also called a stock, you own a piece of the company. And so let's just say, for example, you go to the store. All right. The typical person, sorry for that. The typical person may go into the store and buy milk and may buy bread and may buy vegetables and take it home and eat it. And that was really good. Now you've spent your money and those proceeds went to the company. So the typical customer will go buy those items and go along their way. But the person that is an investor, what they will do is they understand that there's going to be a constant flow of customers buying these products and services. And if there's a huge surplus of products and services being sold, the value, keeps changing, the value of the supermarket would increase. And so the value for investors is what is most important. The price is what is most times important for customers. They're always trying to find the best deal. Hey, can I buy the milk for this price? Can I get this computer for this price? Can I get this iPhone for this price? While investors want to determine, is this company going to outperform our expectations in the future? Is it a wise thing to invest our money into at the time? And so you have to make sure that you understand that when you invest your money in stocks or in your retirement account, it has some intrinsic value. It's not just going into the air and then it doesn't really have any value to say, like with lottery, investing in the lottery, there's no value in that at all. So that's just one thing you have to understand what investing is. Now, because most people are oblivious to just even what I just explained in this first slide right here, we have found that only 52% of Americans invest in the stock market. So the remainder 48% of Americans don't even have a clue what value investing can do. Now, they did a study, and this was a study done by Pew Research, and they found out, based upon the income, race, and age of individuals, they found out, as I mentioned, only 52% of Americans invest. But look at this. They said that if a household makes less than $52,000 a year, they only make up 19 to 44% of individuals actually doing it, right? That are actually investing. Most times, the individuals that invest are individuals that make $53,000 to $100,000 a year. They found out that in terms of race and ethnicity, over 60% of the Caucasian population invest, while most of the minority African American and Hispanic population, it's less than 30%. Now, if you look at also age, they found out that simply, right, under 35, less than 40, close to 40% of individuals invest. But over that, it's close to coming around 50%. And so what you have to make sure to do is to be able to understand the importance of investing at a very young age. My parents did not teach me anything about investing. I had to learn on my own. And that's because their parents never taught them about investing as well. All they taught them what to do was to invest in simple products and services. And so what is so crucial to do is to make sure, first off, why you have to invest for the long term. So we found out from Business Insider that if you start investing at the age of 20 years old, in order to have $1 million by 65, all you would have to do is save $61 a month. $61 a month, and you would be able to have over $1 million. If you started at 25, you would have over $100, right? If you started at 30 years old, you would have to just put $193 aside a month to be able to have $1 million by retirement. If you started at 50 years old, though, it would be over $2,000 a month that you would have to save in order just to reach up to that $1 million. And so it's so important to make sure that you understand to start as young as possible, okay? So here are a few pros and cons of investing. The first pro of investing is that it gives you the ability to invest where you have access to your money as soon as possible. Second thing, it's very inexpensive. It's even less expensive than buying real estate. A lot of people say, oh, I want to buy a house. That's my first investment. It only will cost $50 to $100 to get investing to start off. The third thing is it's easy to diversify when you're putting your money into in a particular stock. You don't have to just set it in one particular company and that's it, like what most retirement accounts do. Also, it gives you low transaction fees. It's also easy to add to tax advantage retirement accounts, and it has a higher return over the long run instead of just saving it in the bank. Now, there's also a few cons about investing. One of the first cons about investing is that it's more volatile than typical real estate market. So if you have a house, you may see your house gradually increase in value every year. But the thing is, if the real estate market goes down, then it can drop as well. But that most times doesn't happen. As you saw what happened because of this pandemic, many individuals lost a lot of money in their retirement account. And it literally was lost within a matter of weeks. And that is just because it's impacted upon the companies that they were investing into. All those companies that were closing down, that's what caused a huge drop in the market. Also is that it can trigger higher taxes if you were only to sell it within the first year. It will usually be taxed at the regular tax bracket, but if you invest and you leave it there for more than a year, it's usually only going to be between 10 to 20% on a capital gain tax. Also, most times these stocks will usually remain stagnant for year upon year upon year. And also is that you have to make sure that when you invest, you remove your emotion out of it, right? I had a client, she had about $350,000 in her retirement account, and she was afraid. She has never looked at her retirement account since she started it. And once I told her to go look at the account, it dropped. She told her that it was about $40,000, right? So $40,000 that she lost simply in a case there, she was really upset. But if she just understood it from day one, it would have been a better experience for her. And that's why if you have a retirement account, make sure you review it every month as well, so that you are not in a panic mode at all. So there's three things that you must do once you're ready to start investing. The first thing that you do is you develop an emergency fund, and recommended is to save at least 1 to 6 months of your income. Once you have at least 1 to 6 months of income, that will make sure that you do not have to touch the money if there was ever a time where you lost your job or anything like that, you can touch your emergency fund and go from there, right? And the second thing that you want to make sure to do is to learn the stock market basics. I'm not going to teach all of you today about how to invest in your retirement account, your 401k, because if you have a job, they provide you with a financial advisor to show you how to set up your 401k. If you haven't educated yourself on how to use it, that's your fault. The first thing you need to do before you invest in anything is you understand how your retirement account works. So just don't make the decision because everyone else is setting up the retirement accounts. Just don't put any dollar value that you think will work. Actually learn the importance of what happens if you start off with whatever figure of number that you can save. You understand what the long-term expectation of that will be. So the third thing is, once you've understood the stock market basics, you must prepare and practice. So when you begin investing, you have to make sure that you have a long-term plan in place and you master how to use that brokerage account if you are going to invest on your own. If you invest through your company, then they probably most times will already do all the investing for you. So the second thing that you want to do is you want to understand that if you delay investing, it can really have a huge impact. And one of the biggest people that a lot of individuals do not know about is Ronald Wayne. Now, Ronald Wayne was an individual that invested, right, and started off with Apple. And he had an investment in 1976 that simply was about the value of $800. He owned 10% stake in Apple for that amount. So with that stock that he owned, simply what would happen is that if he actually had that stock till to this day, the value of his stock would have increased to over $90 billion. So investing that same $800 and holding it for that duration of time would have made him one of the wealthiest men ever in history. But the thing is, because he sold at an early time, that is what caused a huge devastation to his own life, right? And the thing is, I mean, you don't have to be in complete sorrow for him, because I mean, money is not the whole thing of life. I mean, there's a lot more things that you can look at besides money. But I think that if he just was patient during the process, he could have benefited a lot better off. And so when you all invest, for example, your retirement account, any account you have to make sure that you are patient in the process and not try to just take the money out, even if you see a few dollars of gains inside of the account. And so as Warren Buffett says, which is the number one investor in the world, he says the stock market is a device for transferring money from the impatient to patient. He's one of the fourth richest men in the world. And so you must be patient when you start the road to investing. If you are not investing with patience, don't start, okay? And so one of the biggest things that you need to learn today, I'm going to share with you all a few concepts in terms of investing. And the first thing that you can learn is a few terms, okay? I'm not going to go into too much detail of the terms here, but one of the first terms that we have is understanding what is a stock. I already discussed that before. It is a security that represents the ownership of a fraction of a corporation. And those what are usually called shares. So every time you watch the television, you go to, let's just say, or you're on your computer, if you ever hear a stock, just understand that is one piece of the company. The next term to learn after that is a bond, okay? And bond is usually the opposite of a stock, in which a stock is usually controlled by the actual company, while a bond is usually controlled by the government. And most times those are loans that are being requested for the general public to buy so that they can be able to purchase buildings or create bridges. That's what happens when you purchase a bond. And those times are usually going to be very fixed. It will not usually spike up in growth, but it will give you that consistent long-term growth. The next term is to understand the mutual fund. These are usually what you will see with your retirement accounts. When you're investing through your 401ks, most times they will invest it in the actual mutual fund. And this is a pool. And what happens in a pool is that simply what they will do is that they will put your funds in a certain basket of investments. and it will be a pool of companies. And with those investments in the pool, it will allow for the risk to be a lot less than if you just invested in one company itself. Then we also have ETFs. This was made popular recently because it's a lower cost expense to invest through ETFs than mutual funds, because it just follows the exchange. And instead of it investing into just a pool of companies, they invest into the pool of exchanges, right? So they'll invest in the large cap companies as a whole, small cap companies, and go from there. And that is simply how the ETF works. Now, another term to learn is bear market. A bear market is when the market experiences a loss over a set of years. And they use the term of bear because there was a time when, if you looked at a hill going downhill, the thing is that the hill, it would, if a bear was going downhill, right, a bear can't climb right uphill. A bear can only go down. And so that's why they always use the term bear market. The next market after that is bull market. And the bull market is when, as you could see, a bull, it constantly, it tries to knock up its head up when it's trying to hit somebody. So the thing is that the bull is in a stage in the market when there's actually a time of growth. So understand that right now, the market is going up and down. And in some cases, some people may say it's a bear market if the market has lost more than 20%. But also, if the market increases and spikes up, most times higher than 20%, that is what they call it, a bull market as well. The next terms to learn is supply and demand. This is a few economic terms. And in terms of supply, this is one of the terms that they use to determine exactly how much of the company, how much supply do they have of that particular product or service. And it's so important to know that when you're researching a company, because sometimes that company may be completely out of that product and it will not allow for them to continue making a profit. Also, what's important is to understand the demand of that particular company, because if they have no consumers asking for their product or service, how are they going to make any type of income? So when you invest, you have to make sure you understand, are a lot of people actually purchasing these particular products and services? Is there a huge demand, or is just one person, their neighbor, buying the product? If there is only one person buying their product, then that may not be a valuable company to invest into. A few other terms as we close out is also understanding a dividend. And this is usually a passive payout that is provided by the companies that you invest into for being a loyal investor with them. And so they will reward all the investors that they have with dividends, and also they'll put you on shareholder conference calls where you'll be able to see exactly what improvements the company is having and what growth they're experiencing, and not just make sure that, again, you are investing in something that has an actual intrinsic value. It's not the same like investing in the lottery where you just put your money there and you just close your eyes and you think that it's going to grow to $1 million. No, you will actually learn from the companies that you're putting your money into. What is the reputation of this company? Do I really trust in the CEO or the board of directors? Another thing to understand is the stock exchange. So a stock exchange is simply just a financial instrument. And what I mean, the instrument is just the stocks, commodities, bonds. What happens is that they simply have to have an actual location to be able to hold all of these trades that are taking place. So if anyone has ever heard, my office was right next to New York Stock Exchange. If anyone heard of the New York Stock Exchange, one of the oldest exchanges, that's a place where they usually will sell the large big companies. And then you hear Dow Jones, that's another stock exchange, right? Then you hear over-the-counter markets. Those are what we call companies that usually are selling for less than $5 a share. So those are different stock exchanges, and each one of them has different companies that are providing their shares on that platform. Then we also have initial public offering. Right. I remember when I was in piano class, and this is when I was just about, 14 or 15 years old, and I started using Facebook. And Facebook at that time had released to the public that they were going to go public. They were going to release an IPO. And when a company goes from private to public, what they are looking to do is to expand their presence in the public world for people in the public to invest into so that their value can increase even higher and they can also get more funding for activities. And so when I was 14, 15 years old, I couldn't start investing. I wish I was able to invest into Facebook, because if I started off investing at Facebook at that age, I probably know that could have grown to over $500,000, because Facebook is still here today, over close to 15, 20 years in existence. And so there's a value of learning when companies will go public that are currently in a private stage right now. Big one last year was Uber, right? Everyone was talking about Uber when it was going to go public, and everyone had a huge expectation. But I think Uber has a lot of loss this year because of the COVID. So sometimes you may win, sometimes you may not win. And you have to be okay with that when you're investing. You're not always going to see sunshine. So when you go online and you're deciding that you want to begin investing, after you understand those basic terms, after you've educated yourself on the books that are out there, you want to learn a few other things about the screens that you will use. And one of the beginner screens that I recommend a lot of my clients to use is a program called Yahoo Finance. This is a staple for individuals that just want to be up to date on the performance of companies. And simply what will happen is that if you were to, let's just say, type in Apple, which is a great company. Now, this is showing the return from, I believe, last month and a half when I did another presentation on this topic. So this is not the updated number, but once you type in a particular company on Yahoo Finance, and there's other sites as well, you will see the share price, which is the price that a share is selling for. And in this time, Apple was selling for $322.80 per share. So if you wanted one piece of that company, you would need to save up $322 in order to begin investing. So when you type in that company, there's what is called a name and ticker symbol. And that's simply, the name is the name of the company. The ticker symbol is usually just the acronym of the name of the company so that they can be able to easily track it online. Nobody's going to type in the whole company. They'll just type in the ticker symbol, which is AAPL. The 52-week high and low, and you'll see it on most of the screens that you look up. The 52-week high and low just shows exactly the highest that the company has gone in terms of their share price and the lowest the company has gone in their share price. Exchange just shows that this is on the NASDAQ market, okay? The dividend is, as I mentioned, is the return that the company will pay out, usually every quarter. And you could see that this company has dividends because it already explains the next dividend date, right? And also the earnings date. Then we have the yield, right? So where the yield is not going to show on here, so I won't explain the yield. We also have volume. Volume will simply just explain to you, and you can see most times the small lines below the graph, that is showing you the volume. How many people are buying and selling that particular share on a daily or annual basis, okay? Then we have the PE, that is the profit to earnings ratio. And usually, sometimes investors will tell you to invest in a company that has a high PE ratio and sometimes a lower PE ratio. Then we have the open and close, and that simply shows exactly when the particular company opened on the stock market in that particular day and what it was selling at when it started off the day. And the close would show how it ended off, and most times the day before, because most times throughout the day, some people will buy the stock, and when people buy a stock in a large amount of orders, it will increase the value of the company. When people start selling the stock, the value of the company lowers, and that's what brings the close down to a lower amount. So that's the only reason why when you look at the stock market and you see the market dropped 30, 40%, that's just because a lot of people were selling their stocks all at once. If the market shoots up out of nowhere, that's just because a lot of people are investing all at once at that particular time. And we have the bid and the ask, and that just shows you exactly if you wanted to buy, if you wanted to sell, what they're trying to sell it for at that particular moment of the day. And the next earnings date will usually show you the next time that the earnings for that particular company will be. All right, so these are the typical simple terms that you must become acclimated with when you start off investing. Once you understand these basic terms here, then I encourage you to really go and practice on doing that. And I will give all of you information on how to start practicing on doing this. And I can tell you, when you invest through your jobs company, you can even type in the company that they are investing your money into. Most times they'll invest it into Vanguard, and they will have it in a particular fund, a mutual fund, and you can search it online and you can learn exactly how it's performing. You can get on their calls, you can see what's happening, what's the expectation. You don't want to just invest and you don't have any clue what it's doing, okay? Make sure you understand that. So I taught all of you exactly how to understand exactly what the stock table is. And this is the table. But now we're going to understand what is a stock chart. And this is so important because you're able to look at the previous years, the history of how this account performed, and you can try to prepare with what's going to happen in the future. And this is why what they are usually able to determine is that the market will crash for about 1 to 3 years. But what we found out is that the market will usually have a growth for between 5 to 10 years. And that's just because the historic trends. And so one of the first things you must identify is exactly what I said, the trend. If you look at these lines right here, this blue line, this is the trend line. And as you can see, it looks like an EKG machine when you have a heartbeat, up and down, up and down, up and down. When it's going up, that just means people are buying more of the stock. When it's going down, people are selling more of the stock. And so over the set of years, as you invest, look at 2014. If you invested in Apple in 2014, it was selling for less than $100 a share. However, this cannot be a full accurate tool to use because if you look at with the DNS, sometimes the company may lower the price to buy a share. They may do a split, right? And D is just dividends, but they might do a split, which they did right there around 2014, 15, where it actually split the price of the share, may have been in half. And so you would have been able to buy 2 shares for the same price of 1. But as the time progressed, you could see that the value of Apple was increasing and spiking up. The number 1 product that's sold by Apple is the iPhones, right? And right after that, it's not the Apple products, it's actually the service. They said the subscription service that they have. And that's just because of, this is one of the investments that I've made as well in Apple. So you have to understand exactly what is the company doing to actually have more value as time goes by. Then we also have the support and resistance. The support, sorry for that, the support will show you exactly where the line is, the imaginary line of where it's just trying to hang from before it drops. So for example, if you could see the previous low here in 2019, if the market went down to that same amount of 150 and went back up, that will be the support line. That's where it's hanging before it would drop. If it goes below that support line, that's when most people usually will expect for a bear performance on that particular stock. But the resistance line is showing you exactly the highest peak that it has gone. And if it has been able to do the same peak consistently as 2-3 times, if it goes above that, most individuals expect for it to spike up and become bullish, as it's right there. Because it's reached close to the same resistance line, they were expecting for it to increase even higher. So these are just terms that a lot of investors and traders, they understand to know when to invest and when not to invest. And I already mentioned dividends and splits. Dividends is just when the company was paying out returns to the shareholders, and splits is when the company will reduce the cost to buy the share. Okay, so I hope that made common sense on understanding exactly how the stock charts work for your future use. All right, so one of the things that you want to do when you actually have educated yourself, you have the emergency fund in place, you understand how these brokerage accounts works that you will begin investing into, you must research and decide the company that you will use. And I always recommend that you begin investing with companies that you actually know information about. For example, if you love shopping at a particular store, look it up online, type in the name of the company, type in IPO, and see if it's already a company online, and invest into that, because you will know exactly if there's trends in that company. If you're purchasing from that store every week or 2 months, you will know if they're about to close out. And so that will allow you to determine if it's a long, wise decision to make. Second thing is to develop that investing plan, to determine the strategy, time, and risk that will be allocated as you're putting your money there. Understand that there's going to be highs and lows. You are not always going to see growth 24/7. If you see the account lose value, do not jump up and panic. That is a common thing that occurs in the market. And third, you must invest to reinvest. And that's why it's so important to make sure that you have a budget in place so that you can invest consistently year after year, month after month after month. You don't want to invest one time and stop. Same thing with your retirement account. You can't just invest for 1 year and say, I'm not going to invest anymore, because guess what? You're not going to be able to retire. And as they mentioned, Social Security is expected to deplete. So what are you going to use for your investment, right? And so you have to make sure that you will follow those steps. So now, one thing that a lot of people usually want to determine when they're choosing a company is, what type of thing should I look in terms of that company? And one of the things I always recommend is first to find out, is that a well-run business? Second, will the business model work in the long term? Third, does it have a wide MOAT? And that is simply just a term that is used, an acronym term that is used by the actual investors, and they usually want to make sure that it has a wide MOAT. Fourth, is the price to earnings ratio too high, or is it too low? Fifth, is it relying on one income source? And that's a big one. For example, if you invest in Amazon, do you know that Amazon doesn't just sell books? It sells literally everything. And so it has multiple sources of income. So even if nobody wants to buy books anymore, it still has another way of bringing in income. You look at Facebook. Facebook sells way more things than just social media. Most of their assets, income comes from ads. Okay, but they also have other companies that they own, such as WhatsApp, right? They purchase a lot of these companies so that they will be able to, I wouldn't say a word monopoly in the industry, but they just want to make sure that they have their fingers in every industry to be stable. Six, how much value do they provide to their customers, right? Is this company a very basic organization that really doesn't have any type of extra value that they provide their clients and customers? And that's why I always say, buy companies that you actually that you already use, because look at the treatment that you receive when you go to those particular companies, right? If the company doesn't treat the customers properly, then why would you want to put your money there? And lastly, does it fall in alignment with my views and interest? And this is why I believe, especially as a Christian, why it's better to invest on your own than actually letting a company do the investing for you. But I recommend doing it once you're educated, because when you invest through the particular companies that you are completely oblivious to, you may never know who you're investing your money into. But when you learn how to invest on your own, you actually can believe and trust where you're putting your money. Just like how you choose what bank you want to put your dollars into, it's the same thing when you invest on your own in the stock market. You can invest in companies that you actually believe in, and that is doing something that is beneficial for probably spreading the gospel or helping those that are under their income bracket that need help financially. It's very crucial to make sure that your goals and alignments are in alignment with those companies' visions and dreams. All right. So once you have evaluated that, now it's time to determine the stock brokerage. And we're coming down to the end right here. But one of the things I always recommend, if you are a beginner, do not start investing yet at all. They said that it takes 50 books to have the equivalency of a PhD. And so I recommend that you actually just indulge yourself in a lot of education, before you invest. Even in your retirement account, before you set up the retirement account, learn how it works. And so one of the things that I recommend is to start up a retirement account brokerage, just to simulate in practice if you are actually investing. And you can do the same thing for a retirement account. You can go type in investment calculators and see what is the expectation of the account going to do if I put the money there, and those things, because you do not want to put your money in the account and then you cry and complain when it lost $1. All right. I've seen people do that, right? You want to make sure that you understand it, because there's people that have cried over $1 and there's people that have committed suicide over losing hundreds of thousands of dollars because they were just quick to putting their money there without understanding it. Now, when you're in an intermediate stage, and I would recommend these companies that I'm referring to do your due diligence. I'm not sponsored by any of these companies here, but you want to make sure that it's the right company that you chose. But intermediate, which is the middle, is to start using Robinhood and Stash. And I can say I've used Robinhood and I've seen exactly the advantages and disadvantages, but it's not the master investment brokerage that you want to use, because it doesn't really allow for you to have control of the stocks that you purchase. So if you're just getting your feet wet, then you can go ahead and use Robinhood and Stash. I mean, there's companies like Acorns. Those companies do not really allow for you to buy an individual stock. So I would really use these companies that I'm recommending here. Particularly if you have children, I recommend trying out Stash after you do your due diligence, because you could actually set up a custodial account for them. And every time that they receive an allowance or anything, they can buy stocks. You could also give gifts to people. For example, when I have baby showers, I don't buy the baby items. I will go and buy them a stock, right? I bought one of my recent clients, I bought her a stock of Amazon, and I know that Amazon stock has definitely increased, instead of just buying a few pacifiers and beds that will no longer have any value after the first day, okay? Now, once you've actually become advanced, then I recommend looking at to advanced companies such as TD Ameritrade and E-Trade. But those require experience, training to do that. And so there's a lot of information on videos online to be able to understand exactly how it works. And so you definitely want to make sure that when you are simply investing in these companies, right, you have a great brokerage that you're using to put the money there. Okay, so here's a few books that I recommend to read just to start off when you begin investing. One of the great books that I enjoyed reading as one of my first started books that I read when I was 16 years old was Stock Investing for Dummies. Okay, we are all dummies in terms of investing for the first time, and so definitely go ahead and read that book. And then after that, I would recommend go straight into The Intelligent Investor. But that may be a little difficult to understand. However, Billy Graham was one of the tycoons in investing. So if you don't understand these books, because it may be very difficult to understand, start off with these 3 books at the bottom. Very common sense, easy to understand, and they are rated as one of the top bestsellers on the book catalogs. So this is simply one of the things that I recommend you do before you invest in anything. Invest in knowledge. Read on it, just exactly how important it is to read your Bible. Don't go to church without reading your Bible. How is it that you're going to even learn? You can't just rely upon the pastor to teach you about Jesus. You have to learn it yourself. Study to show thyself approved. And so study so that you can make sure that you can prove that your investment was worthwhile. All right. And so as it says in Proverbs 21, verse 5, the plans of the diligent lead to profit as surely as haste leads to poverty. And what does haste mean? It means quick. So if you're making investments or decisions financially with just a quick mindset, without doing any research, without praying and asking God for wisdom and instruction, you're just doing it because everyone else is doing it, you're eventually going to lead yourself to poverty. But if you are diligent, you are wise in your decisions that you're making, you actually pray and ask God for wisdom and instruction, you actually do your research, understand how it works. You don't just let the person explain it to you. You try to explain it to yourself, to that person, right? And once you've done that, and you can even explain your understanding of that term to a little child, then that's when I would say it's time to gain a profit on whatever you put your money into. And so always make sure to do your due diligence before you put your money into anything. Do not rush, because there's always going to be an opportunity. They say that it doesn't matter the time that you get in the market. What's important is just how much time do you last in the market. And those that last long in the market are those that understand the market. All right. And so I want to definitely thank all of you for giving me your time to explain to you just a speck of what investing entails. And if you actually want to speak with me one-on-one to gather more information, then you can simply go to these links that are right here on the screen. If you want to receive a free ebook by me on finance and also a few tools on investing, you can also type in the second link straight on the screen right there. And I will definitely be appreciative of that, because at least I have a few individuals that are ready to implement instead of just taking in all the knowledge without applying it. And so thank you so much for your time. And here's my information. If you want to reach out to me, you can reach out to my email. You can contact me on my cell or my office line, or you can visit our website. So thank you all. Have a great rest of the blessed day that God has provided you with. Take care.
Thank you, Archie, for that information, and I hope we will apply it. Now, do we have any questions for Dr. Simon and Jonathan Archie?
Yes, Elder, Clark here, bro. Yes, I'm glad that to Archie there, the financial guy. I'm kind of glad that he explained, because a lot of time when we see the stock market, it's up and it's down, it's up and down. So he really kind of explained when it's in the red, that means that they're selling, right? And then when it's in the green, that means that it's people buying it. That's what he explained.
Yes. Hello. Thank you so much, Mr. Clark, for your interest in that. So, what was your question exactly?
Yeah, I'm glad you explained. You kind of explained when the market is in the red, that means that they're selling a lot, and then when it's in the green, that means say they was buying. I think that's how I explained it. But you did kind of explain it, so I kind of more understand. So I don't know if you want to go over that again, Archie.
Yes. Great question there. So that's simply exactly what happens. I mean, there's a lot of outside influences that determines the market, such as the COVID-19 that took place, and that impacted a lot of the labor infused companies that were requiring manual labor to do work. And with those companies not able to conduct business, it had a huge impact on the actual not the demand, because of a lot of people. Let's say, for example, Amazon, right? Amazon, they have a lot of factories. I mean, they had a great program. They had factories that were in America that were able to make sure that all the manufacturing of the goods were streamlined and they were able to process good. But once COVID came, then what happened is now no one can go into work. And so all those manufacturing that would be needed, it can't take place. And so even though there's a huge demand of customers buying on Amazon, there's not a supply of the workers. And so that reduced the value of Amazon at one point during the start of COVID. But eventually they were able to withstand that and get back going. But yeah, when companies' values decreases, either because the supply and demand is impacted, it will reduce the market as a whole. And that is just because there's different sectors in the stock market. And there's sectors such as the health, there's sectors such as the tech, there's sectors just as commodities and goods. And if there's many sectors that reduce and like, for example, the transportation sector, that took a huge toll, and that impacted everyone else as a whole, because what happens is there's a lot of word of mouth when one market is one sector is impacted, and everyone starts building up a fear. They get emotional, and everyone is trying to sell. So everyone was taking money out of their retirement accounts. Oh man, the world's coming to an end. They took money out of their retirement accounts, so those companies depleted as well. So because everyone was just taking a huge chunk of money out of their investments and retirement accounts, that is what caused a huge loss. And that's why when you get really in tune into investing, only watch the news of the companies you're investing into, and try to watch the world news, not the US news as much, because you want to see exactly what's happening. Because if you watch the world news, you would already understand that what's happening in China when it started off, you would already be prepared to understand, okay, this might come into America and impact what's happening here, because China is one of the biggest import exporters of America. So you're able to pre-plan properly. And so that's just the constant cycle of the market, and it will go up and down, but that's how life is when you invest. Okay.
Yeah, got it.
Amen.
We have a question here asking for the list of the books. Can you add it to the chat on the list of the books' names?
I sure can. 1 second.
And Dr. Simon, we have a question here for you. If I work weekly, how do I budget?
Great question. Remember I said earlier in the presentation that it all boils down to cash flow. So if you're paid weekly, it might be better to budget on a weekly basis. As short-sighted as it may sound, you might be able to manage things more on a weekly basis than if you try to stretch it out. Must also remember that a budget can be one tactical. That is a series of short steps you take to get to a monthly budget and eventually an annual budget. So for example, if you're working weekly and you want to plan a trip to Barbados for summer next year, then you're going to ask me, well, how do I do it? Well, then you have to start making that projection over a number of periods. But if you're receiving monies weekly, you will want to use a weekly approach to budgeting as opposed to a monthly approach.
Excellent. Johnson, how much should I be investing in a month?
Yes, that's a great question again. And I think I had that on one of the slides. What I recommend that you should do first off, after you've given you've done your budget, you've put your amount for giving, you don't immediately go and pay your bills. As Dr. mentioned, you first try to make sure that you invest. And I recommend that you try to put aside 10 to 30% of what you make into saving and investing. Okay. If you do not have an emergency fund in place, put the majority of that percentage into an emergency account. And once you've reached between 1 to 6 months, then you can split it up in half. Half goes into the savings. The other half of that 10, 20, or 30% will go into an investment account of your job retirement. After you've maxed out the retirement, or you probably want to start doing things outside for children or for yourself, then you put that into a separate brokerage account. And when you buy a stock, just say, hey, next month, I'm going to go buy another stock again with whatever 5% that I have left of my paycheck. Because if you say, I just want to save $500 a month for saving or investing, if your income increases, then you may think that $500 was enough. And that's why even God says, he never said, I want everybody to give me $100 a month. He said 10%, because he knows that some people make more, some people make less. But 10 to 30% is all you need to work with. If you try to invest or save more than that, then you actually may end up taking a lot of the money right back and putting it right back into your spending of bills. So try to start off small. Start off with 10%, then increase it to 20%, and then start committing to 30% a month of investing.
Excellent, excellent. So, can you please explain the difference between a traditional IRA and a Roth IRA account? This is whole part of retirement investing.
Great question there. And it's great to understand the different types of IRAs, because most times your job, they will provide you a 401k, 403, 457, deferred comp, TSA account. Those accounts are usually provided with the companies. But if you're an individual that doesn't work for a company, particular company that provides a retirement account, or you've maxed out the amount for your retirement account, you need to find a supplemental retirement account. And so that is what an IRA is. It's an individual retirement account where you're able to supplement, not fulfill retirement, supplement retirement for the long term. And the reason why it's only a supplement is because they put a maximum contribution that you can put in a year. And every year the IRS changes the number, but it's still less than $10,000 a year that you can put in that account. And that will not allow for you to reach enough for retirement. So if you've maxed out every other account, the traditional IRA allows for you, once you contribute into that account, you're able to deduct it on your immediate taxes every year. And so that is a great option for individuals that make a certain income that just really need to reduce their tax liability. Now, once you're in a position where you actually do not care about your tax immediately, you may focus on wanting to make sure you don't have to pay taxes later on. And that's where the other side of people will set up a Roth IRA. And the Roth IRA allows you to contribute close to the same amount, but when you take it out in retirement, right, it allows you tax-free. So it's under a tax deduction. Really the difference between a traditional and a Roth IRA. One thing to let you know, the Roth IRA has income limits in order to use that account, because Uncle Sam doesn't want you to make $1 million a year and you're using the Roth IRA as a safe haven to get tax-free benefits. So they cap you on how much you may be able to, if you qualify, based on income. And it's different if you're single than if you're married. But if you're single and you make over 6 figures, sometimes you may not qualify for the Roth IRA. You may have to just go through the traditional. So just make sure that with your CPA or accountant that you have, you ask them, do I qualify for this IRA before setting it up on your own?
Okay, thank you. Dr. Simon, a question is here. My husband and I have do separate budgets, but agree on paying bills. Is this a good thing?
Great question. I think I alluded to some of this in the presentation when I said that it's always better if, as a household, you're budgeting in a uniform manner. I think the presentation on investing will help us to understand why is it you need to declare all that you have on the table at any one time. If you want to generate enough money to put into stocks, then you need to have accurate figures as to what is going on. If a husband and wife are doing their own thing in the background without each other knowing, that defeats the purpose of the budget in its entirety. So you need to have that common understanding that budgeting is about trust. It's about respecting each other. It's for the household. That is important. So there's no wisdom in husband and wife having their own separate budgets. You do your thing. Let's assume that I earn $3,000 every 2 weeks and my wife earns $3,500 every 2 weeks. She takes care of X bills, I take care of Y bills, but the rest of it, don't ask me my business. I think that defeats the purpose of why you're budgeting. Because then if you want to make bigger plans, how do you go about making the bigger plans? Or like you want to invest in a property, how do you go about? Then you go to the table and then you're learning about how many credit card bills someone has outstanding. You know, it creates a lot of problems, and this is in a family setting. So that is why you want to always be clean when it comes to budgeting as a family.
To you, Dr. Sam, another question here. I find it difficult to control spending. What advice do you have for me?
Great question again. Last week I spoke at length about why it is necessary that if you have problems controlling spending, it might be part of a larger issue psychologically, and you may need some amount of counseling. Overspending is not just a game. Overspending is a sign of a larger issue from a behavioral perspective when it comes to individuals. So such a person may want to meet with a financial therapist, someone who's trained in behavioral finance, as I said last week, and work around this whole idea about overspending. But overspending should not be seen as a joke or just a gimmick. Overspending is a sign of a larger issue in that person's personal life. Chronic overspending.
Yeah, a question to Archie. Archie, what you think is beginner investment? Because you have like you said, if you have a favorite store that you shop at, a Target or Walmart, McDonald's, or different stores. What do you think it's if it's good to start at one of those small investments?
Yeah, great question, Mr. Park there. So the first thing that I would recommend that you do is that you try to, yeah, look at your spending habits. And for example, I was enthused with Apple a very long time ago, and so what I would do is I first went online and I tried to be attached to every single company. Um, let me just make the Mrs. Scarlett, just put yourself on mute. Okay, great. So one of the first things that I did is I went to the Apple website and I tried to make sure that I was getting alerts every single week or 2 weeks or month when there was new updates being released. And you can easily do that with the company that you love to invest into, get a part of their newsletter programs. You're able to see exactly when they're doing conferences. For example, Apple, they always release new products around September, November. So if and especially if you look at their commercials, you see that the product is really revolutionary, expect for the value of that company to spike up. So if you're attached to those newsletters, you can really get ahead of the game. Also, you look up when you type in a particular company, if you're on Google, type in the news. There's going to show you photos, say images. There's different categories of whatever you search, and type in the news under that Google search of that company. And you will see the news releases, the press releases of that particular company to see if it's really being talked about at that moment in time, if something good happened or something bad happened to that company. I used to invest into a lot of pharmaceutical companies that said that they were going to be releasing a new advancement in cancer. And every time that they said, found a way to invest, they were going to be able to find a new advancement in cancer, the company was able to spike. And so I actually was able to know when to invest because their company had released a new advancement. And so I really can't give you the best company, I would say, to start off. Just look at your spending habits and work with that mentality that I just shared with you.
Okay, thanks. Oh.
Archie, next week we will have our topic on entrepreneurship. What are some investment vehicles, avenues, an entrepreneur will have? For instance, what type of IRA account can an owner, self-employed, have versus a traditional and Roth IRA?
So is this a different question from before about the IRA?
It's a different question, yes. It's targeted towards an entrepreneur. What kind of retirement vehicles should they use?
Oh, great question, great question. So for the general public, for typical employees, it's recommended to use those two options, a traditional or Roth IRA. But once you become a business owner and you have your business structure where you actually have an EIN and you actually have a business bank account, then what may be best suited to start off with is a SEP IRA. And these are particularly for business owners. They allow for you to be able to put, I don't know if it changed, but up to 25% of your business revenue into those accounts. If you set up a traditional Roth IRA, the IRS will not really want you to do that because it's typically for W-2 employees. And so that is the first tip that I would take. But in terms of that tax advice, again, it's best to deal with your accountant, first of all, that you use when you're starting up that business to give you the guidance on what type of IRA to start. And then once he guides you on what type of IRA to start, then you can come speak with me and I can direct you to the appropriate advisors that are investment licensed to be able to actually put you onto their company to invest with. Okay?
Thank you. Dr. Simon, you mentioned in your presentation that it is good to have your children engage in the budgeting process. What's some kind of skills or games or practical approach you would advise us to do that?
I always remember that as a youth, I played Monopoly a whole lot. Not sure if it makes a lot of sense, but it taught me basic things about money. And I think one of the things we neglect our kids from doing is to understand what are the basics of money. So there are several ideas. One of them is that we can teach them the art of the very stock market and be their custodian. We can teach them how to do that. When it comes to basic budgeting strategies, you can give your child a certain amount of money. I do it. I give them monies and I expect them to do a couple things out of it. One of them, you pay tithe out of it. That's one. Number two, you show me a plan of how you're going to use this money, what part of it you're going to save. You're not going to come back to me in 2 weeks' time and say, you know what, all the money is done, Daddy, I need more money. I'm like, what did you do with it? So you have to hold them accountable with small things. My saying is that if you can't champion small things, you will never champion big things. So that is why you have to teach them from the early age with small sums of money to be able to manage it so that they can manage bigger sums of money when they get older. Half of the reason why a lot of people can't manage a lot of money in their hands is because they were never taught in the beginning how to manage small sums of money. So they mess up at a larger level. So those are little ways you can teach them how to save, but let them be involved in the process and let them understand why they're doing what they're doing.
Great, thank you. Archie, we have another question here for you. Within the church, there is this dogma that investing is a bad thing and it's gambling. But is that biblical?
Okay. So great question there about investing as a gambling, and I've already discussed in the beginning Bible verse in Matthew 25 exactly what happened with the master when he provided those individual talents. and actual research even more into detail, the individual that had the 5 talents, he actually went and traded it into the exchanges of the markets. And that was in that time sense back then. And so, as I mentioned in the beginning, when you simply invest, all you're doing is just putting your money into a particular company and you're expecting for them to do well in the future. So when you put money inside of the bank, you have already invested as well. When you have a retirement account, you've already invested on already at that time period. And I haven't seen churches saying don't invest in your retirement account. So if you've invested in your retirement account, it's the same as if you're investing on your own. But the difference between investing and gambling is that investing, you can expect value for what you're putting your money into. When you gamble, there's no return of value for the dollar you put into it. And a lot of people that invest, they're doing it with the mentality not to be patient to receive something. They're expecting to receive it in that exact moment in time. And so that is the line that you have to make sure you understand between the difference of investing and gambling. And even the spirit of prophecy, Ellen White even discusses exactly the importance of having sound investments in place. And this is in the Council of Stewardship for when there is going to be a terminated income so that you do not have to rely upon the burdens of other individuals, particularly your family. And so every time you put money aside, understand that it's the purpose is for it to be able to be of more value for when you retire at that time. And in Luke, it says, occupy till I come. And so you don't want to think that you can just expect for God to come tomorrow, and you do want to hope for that. But until he comes, you have to make sure that you have things in place just in case you reach retirement and you have to spend a few years living off of your expenses, especially when your health may eat up the majority of your money.
Great. One question to you, another question to you, Archie. We know that at the time of this recording and presentation, we're in this whole pandemic and economic downturn due to the pandemic. What strategies would you recommend to invest or to keep our finances stable? And we've already tapped our emergency fund. What are the things you think we could do?
So who's going to answer? Okay, so great. So you have another part of the question?
The question is.
No, I've heard the beginning of the question. I thought you were adding something else. Okay.
No.
Okay. All right, great. So you had a question, what do we do in this current time of the COVID? And so what I recommend, first off, more than ever, is have the largest emergency fund in place. I recommended when you invest, you have at least 1 month minimum saved up. I recommend that you get that to 6 times your income and or your expenses saved up. So if you're making $4,000 a month, I recommend that you save 6 times that, which would be $24,000. And the reason to do that first before you invest is because if you lose your job, which is one of the biggest things that is happening right now, you do not want to be in a position where you're going to have to sell all the investments that you have, take all the money out of your retirement accounts just to survive. So that should allow for you to cushion yourself for at least 6 months. And then as soon as you do that, go ahead and invest. But one of the webinars that I encourage all of you to attend is the course on entrepreneurship. Because a lot of people, they'll invest their $100, $500 into an investment, and they expect for it to turn to $1 million in 20, 30 years. Well, I have something to tell you. It's impossible most times, most cases, for your $1,000 to turn to $1 million, even in a 30, 40-year period. But what can definitely turn into that size is if you have a business, because you're able to receive a passive income if you understand what the supply and demand is of your product or service, and you have a big amount of people that need your product. If that is the case, then you're bringing in that $500, $1,000, $2,000 a month, which would increase your income immediately. So when you invest, you have to keep that there for minimum 5 years for you to really see something substantial. If you can't be patient for that, don't do it. Just save it in your bank, build up your emergency fund, and learn how to start a business at least, because that you can at least receive a profit in under 5 years. It's not going to be huge, but it will give you a bigger return than buying a company that you may not be patient to invest into.
Thank you. So we'd like to thank Professor Simon and Johnson Archie. Do we have any more questions?
Yes, yes, Ella Ray, to the professor, I thought it was a good thing that he encouraged, especially our ethnic group to learn about fun at this, at this age, and because it's not a widespread thing. So I think it was a good idea. Professor N. Archie talked about, in our ethnic group to learn about investing.
You're welcome.
Thank you.
All right. If we have no other questions, so we will conclude this webinar today about budgeting and investing. But I hope we come back next Sunday for the conclusion, for the grand finale about entrepreneurship. We'll learn many strategies of how to grow and build our wealth within the form of a business. Thank you, and see you next week.